name's Creon Butler, and I'm the Director of the Global Economy and Finance Program in Chatham House. And I'd like to welcome you to our next session, which is titled Euroshock: How the Largest Debt Restructuring in History Helped Save Greece and Preserve the Eurozone. And we're enormously lucky to have with us today to talk about this subject, Charles Dallara. Charles has an enormously distinguished career in the US government, advising President H.W. Bush and President Reagan as a senior official in the US Treasury. He also was the managing director for the Institute of International Finance, I believe from 93 to 2013, so that's an extraordinarily long period. And he's currently an advisory partner at Partners Group AG in Switzerland. And Charles actually has a book coming out on this subject, so we're going to have some insights, I think, into what his book's going to say. Charles will kick off with a few introductory comments, and then we'll go into a broader discussion around the experience of debt restructuring back at those crisis days, and also what we hopefully have learned from that experience. But Charles, over to you.
Well, Creon, let me first say what a pleasure it is to be with you here tonight and to be back in Greece. 11 years after the tumultuous and painful process that many of you will recall. I see an old friend of mine here on the front row who will particularly recall it because he was the finance minister during the POSOK period when the government discovered just how serious the fiscal hole was, and he led really the initial efforts to stabilize the economy. You know, it was a painful period. It was a difficult period, not just for Greece, but I would like to stress that it was part of a broader Euro crisis. Here in Greece, we tend to focus on the Greek dimension of this crisis, which was the most severe. But at the same time, you had crises in Ireland, in Italy, a great deal of economic instability in Spain, Portugal. It was a difficult period for the entire Eurozone. It is remarkable to me to see how the Greek economy and the Greek people demonstrated resilience through all of this. The fabric of democracy was frayed here, and I think we saw that in evidence when, despite the world's largest debt restructuring in history, the system here struggled to find a path forward, particularly in the middle of this last decade. I feel, though, that considerable progress has been made now. The economy has regained momentum and, frankly, is impressing a lot of people around the world, including investors like the company that I represent, which has invested over $1 billion in a Greek pharmaceutical firm. Still, it's important that we look back at this episode of massive instability in Greece and the Eurozone and think about the lessons learned so we can improve the framework through which international finance operates and avoid the potential of a repetition of this painful episode for Greece and for Europe.
Well, Charles, thank you very much. Can you take us back to those days? You, in your role in the IIF, were responsible for, if you like, corralling the private sector and inputting the private sector view into those negotiations. And tell us a little bit about, you know, the challenges you faced, but also the outcomes as you saw them. What were the main achievements from that role?
Well, you know, the challenges were multiple, as George Papakonstantinou will recall. Neither Europe nor the IMF knew quite how to approach the Greek crisis because it was virtually unprecedented. It was unprecedented to think of a member of the Eurozone actually having to restructure their debt, and therefore the initial pressures which arose on the Greek economy created waves of instability, but no clear path forward. Now, the government at that time, I'll have to say, spoke honestly to the seriousness of the problem. And this was not just a problem that was created in the early months of the new administration led by George Papandreou. It was a problem that had accumulated throughout that decade, the first decade of the 2000s, and frankly, it reflected structural problems in Greece that go back decades. But the fact is that when the huge increases in the fiscal deficit were discovered by the Greek government, that shocked the markets. The markets simply pulled back and refused to provide external sources of finance, refused to provide any additional finance. So it was imperative that the Eurozone member countries and the IMF step up. But the Eurozone did not have an adequately funded facility, and the IMF was, quite frankly, perplexed as to how to deal with it. Eventually, the private sector and the leaders of Greece and the leaders of Europe realized that a massive restructuring of the debt was going to be needed. But it was painful to get to that stage. Finally, in the course of 2011, we engaged in a series of negotiations. But even then, Europe was mightily uncertain about how to proceed. And I think that it's a miracle, in looking back upon this, that we actually reached agreement in early 2012 to wipe out over $100 billion of Greek debt that was held by the private financial community. That's the largest amount of debt that's ever been extinguished at any one point in time in financial history. And we not only wiped out 107 billion euro of debt, but we stretched out the remaining debt over a 30-year period, 10 years grace, 20 years of repayment, which begins actually at some point this year. The story, though, I think is not complete without understanding the damage that this period of turbulence did to the Greek economy and the Greek people. Unemployment, as many of you will recall, accelerated to as high, I believe, as 28%. Youth unemployment pushed close to 40%. And in my mind, looking back upon this, yes, many of the problems were a function of the weaknesses of the Greek economy, but the burden of adjustment fell too heavily on Greece. It should have been spread more evenly throughout the Eurozone, but the facilities and the political will to do that at the time were simply not there, Creon.
Yeah. I mean, when you look at the Greek economy today, I mean, as you say, there have been reforms that started back then and been continued. To some extent, Greece is also in a situation where it has a lot of nominal debt over a very long period of time with a fixed rate of interest. You know, an inflation shock is actually, at least in a very narrow sense of your debt burden, is not a bad thing to face. But how do you view the Greek economy now? And, you know, to the extent that there are more things you wish had been learned, what would they be? Or, you know, how would you assess the Greek economy now and its prospects?
Well, you know, mistakes were made by all the parties in the Greek negotiations and leading up to the Greek negotiations. For example, the private financial community failed its responsibility to evaluate Greek sovereign risks throughout the decade leading up to the crisis. Let's face it, they turned off the switch. They engaged in a presumption that Germany and the northern countries of the Eurozone would somehow be there to support Greece. And it turned out to be an unjustified presumption. And the poor risk management skills and applications of the private financial community were an important part of the problem which accumulated. And again, even though the banks ultimately took a massive write-off, it wasn't comparable to the pain that was experienced in the Greek economy. But one of the bigger mistakes that was made in the negotiations was made by the IMF and the European Commission, actually, because they assumed that we had to somehow achieve this arbitrary target of 120% of debt to GDP. Now, if you look at the debt that Greece has today, it's roughly 170, 180%, I believe, of GDP. But no one is running around about to have a heart attack. Why is that? Because the IMF and all of us have learned a lesson about how to evaluate debt sustainability. It's not just a question of the volume of debt relative to the GDP, but it's also a question of the interest service that you have to pay on the debt. And Greece is benefiting substantially now from the low interest rates agreed by the private creditors, as well as the increasingly favorable interest rates which the official creditors have extended to Greece in recent years. Both sets of creditors now have contributed significantly to a debt profile for Greece that is actually quite manageable now. I see the Greek economy as steadily regaining momentum. I think a lot of the policies of the last few years have gone in the right direction. You have a good bit of fiscal discipline here, although that continues to need to be monitored very carefully. They've been able to use the EU Recovery and Resilience Funds quite effectively. They had strong growth last year. It will be moderated this year against the headwinds of the war that Russia has created, as well as the high inflation rates, energy prices, et cetera. But I think it's important that Greece sustain the underlying reform momentum that has been created, because the deep-seated structural problems of Greece have by no means been fully eliminated.
Thank you. Well, obviously the other key kind of player in this, where lessons hopefully have been learned, is the European Union and the architecture in the European Union, but also the global system. And there have indeed been developments since then, as you pointed out. The next gen EU is something that just couldn't have been conceived of at the time of the Greek crisis, albeit the circumstances very different. So what now do you think are the main lessons that still need to be learned in terms of the European architecture for dealing with problems of this kind, should it ever happen again, or the global architecture for that matter?
Well, I think let's focus first, maybe as you suggest, on the European architecture. First, I have to give credit to Brussels and to the leaders of Europe for the facilities they have created in the last few years. This growth, this recovery and resilience facility is quite a remarkable step in solidarity. However, the future of the long-standing growth and stability pact in Europe remains a bit a question mark in my view. How does Europe view this framework, which was created way back in the Maastricht days, 3 decades ago, as we try to create new dynamic forces of growth and solidarity in Europe today? If you look back at the initial concepts of creating the Eurozone, most leaders in Europe at the time, including German leaders, viewed the necessity of fiscal union to go alongside monetary union. The eventuality was not the case, as we know. And there is not a great upswell of support for fiscal union in the politics of Europe today. And yet, it's difficult not to view the entire Eurozone project as an unfinished project without banking union, without a greater integration of fiscal policy. It seems to me that it's time for Europe to find a way to step back, look at the structural improvements that still need to be made in the way in which the members of the Eurozone work with one another, and intensify the crisis prevention measures, but also prepare in the eventuality of another crisis. If another Eurozone member got in trouble today, there is still no clear understanding on the relative roles of the IMF, the European Commission, and the ECB. This was one of the severe problems we faced when we were trying to negotiate with them on behalf of the private creditors. That issue has not been resolved. How does the IMF relate to a country in difficulty which is a member of the Eurozone? I would love to see the IMF and the European leadership sit down and talk this through very carefully. Of course, not all of the challenges need to be faced just in the Eurozone. The IMF needs a lot of work from an architectural point of view itself. I served on the board of the IMF for 5 years. I was responsible at the Treasury for many years for our policy toward the IMF, and I fully respect the strengths of the IMF. It's a strong and powerful international financial institution, but some of its policies and practices really need updating and modification. Let me give you one example. It became clear during the Greek crisis that they had an overwhelming number of macroeconomists who really did not understand either the history of Greece, and I'm not talking about the classical history, I'm talking about the modern history, nor did they understand the structural realities of Greece. And as a result of this, it was not only a question of misdiagnosing the problem, but mistreating the problem. The IMF really needs to diversify and broaden the base of talent that it brings into the organization. Yes, have a core of highly respected, capable macroeconomists, but bring in some political scientists, bring in some historians, bring in people who really understand the countries that they're dealing with and the uniqueness of a country sitting here in this part of the world as a member of the Eurozone. But I would go beyond that. The IMF needs to enhanced dramatically its transparency and its work with the private financial community. One of the great frustrations that we faced, yes, we as the lenders made serious mistakes going into this crisis, contributing to the crisis. But at the same time, there's absolutely no reason, no legitimate reason, why the IMF should not be much more open and transparent about how it approaches the design of an adjustment program. Not just with the borrowing, not just with the country whose economy is being adjusted, but with the private creditors who are going to have to be part of that adjustment process. I think this process of transparency has been declining on the part of the IMF for years, since the 1980s, and it seriously needs to be revived, in my view.
Well, Charles, unfortunately, we're out of time. We could go on for ages talking about this. There are many issues I'd like to address, including, as we were talking earlier, the role of China back then and the role of China today in terms of low-income debt relief. But unfortunately, we don't have time. But thank you so much for your observations now. We look forward very much to your book to come.
Well, it's a pleasure to be with you, and I look forward to continuing to participate in the program in the next few days. Thank you
very much, Charles.
Thank you.